Hello everyone, I'm Sandeep Sharma from Skillscape. Welcome to the program One New Concept Every Day. This is a series of short videos designed specifically to help you revisit one new business concept every day. Today, let us look at what is private equity and how does it work. Assume that you are the CEO of Amex International, which is an unlisted retail firm with $200 million in annual revenues. Your firm plans to open 20 more stores in your country in the next 3 years. One of the key requirements for this expansion plan is the finance. You need $20 million for this expansion. How do you arrange for the finance? Well, you could either go to a bank and get a loan for $20 million. This is an example of a debt. Or you could go to the stock market, list your company on the stock market and raise the capital required. There's another possibility. Suppose that there is a firm called KKR, Kohlberg Kravis Roberts. This is a firm based in the US and it agrees to provide you $20 million for a 5% equity stake in your company. This is an example of private equity. So what is private equity? This is an investment in assets in which the equity is not publicly traded. Remember that your firm was a private listed company. It was not listed on the stock exchange. So how does a PE firm work? At the first leg, there are two stakeholders. The first is a private equity firm that is formed by a group of people called the general partners. They are responsible for the day-to-day management of the firm. Then there is a bunch of investors who are called limited partners. Together they pool in money and form a fund which is called a private equity fund. The PE fund evaluates different companies through a thorough due diligence process and makes investments. Now why does a PE firm need to make investments? It has to make investments in the hope of acquiring an asset cheap and then quickly improving the earnings of the company so that it can sell its stake at a higher price, maybe after some time, maybe after 5-7 years. This is called an exit and is done through processes such as an IPO, which is initial public offering, or the sale of its stake to an external PE firm. Now, the other question is, how does a PE firm make money? Now, it generally makes money through two different ways. The first one is when a fund is established, the PE firm retains a percentage of the funds raised. Normally this lies between 1 to 2% per year for the life cycle of the fund. This is called the management fees. Also, when an exit takes place and the investors are paid off, a percentage of the proceeds of the sale passes on to the PE firm. These are the two ways, carried interest and management fees, in which the private equity firm makes money. So let's look at the examples of some of the private equity firms. You must have heard of the following firms: the Carlyle Group, TPG, KKR, which I have mentioned before as well, the Blackstone Group. Well, these are some of the largest private equity firms in the world. So let's also look at who invests in these PE funds. Normally there are institutional investors. Examples of institutional investors are insurance companies, public pension funds, corporate pension funds, high net worth individuals, endowments of universities, and funds of funds. The last is an entity in which retail investors like you and me can invest money. And then this entity invests in different private equity funds available. So this is all that I have for this session. Thank you so much for listening to the video. I hope that this was time well spent. You can visit the website Skillscape or the YouTube channel for more videos. Have a nice day.